Okay, so it's week 2, class 1, and we're going to get much deeper into the technical side of things in this class. So today we'll look over chart patterns, what are pips and lots, support, resistance, liquidity zones, order blocks, just some of the important stuff, and we look into this much deeper in the SMC section. Yep. We look at round psychological levels and quarter points. So let's actually take off from where we ended last week. We finished learning the candle patterns, right? So now we're going to be looking at chart patterns first. And these patterns that I've mentioned here there are many more patterns as such, but these are the patterns that I personally like to keep an eye on. And I have noticed over the years of trading them to be the most effective. So my favorite out of these as well, if I had to filter these out as well, is the inverted head and shoulders, right? The head and shoulder pattern, the double bottom, the triple bottoms, right? And especially when it comes to these patterns in the bottom, my favorite is this ascending triangle. Or if you look at the bearish side of things, again, the head and shoulder, the double top, the triple tops, and the bearish descending triangle. And what you need to know is you don't need to, again, memorize these terminologies. They are just terminologies for you to understand these patterns. But just like the candle patterns, you need to understand what kind of story are these patterns as well giving you. So let's go with head and shoulders pattern first. I think I did see a good one today. I think it was on Bitcoin. Let's see. Yep, I think it was this. So we'll go over on the weekly time frame. Or even in the monthly. So on the month, we have actually two good patterns here. So let's look at the double top pattern first. And what do we see, right? We had a price rally up, right? Bullish rally, created a new higher high, a new higher low, right? And then we had a high, which is pretty much the same as the previous high. This here would be considered as a double top. And this is a bearish pattern. So what happens, right? Once the double top is created, what do we notice? A breakdown, right? So we got a new a new lower high, and we got a nice break towards the downside. So on the monthly chart here, if you see, that's the story this monthly time frame is telling us. So if you look at the weekly time frame here as well on the Bitcoin, you have a head and shoulders pattern play out, right? And you see how this is your left shoulder there, your head and your right shoulder. And usually the left and the right shoulder are usually aligned. It doesn't have to be perfectly aligned. Sometimes the right shoulder could be a little bit up. That's completely fine. And if you actually just look at the story, this particular pattern that is telling you, you see how this was a higher high, a new higher low, a higher high, right? But this candle there is a new lower high, right? And we have a lower high there. Sorry, a new lower high and a new lower low. So this pattern here usually indicates that there is a trend reversal going to happen from bullish to bearish, right? So this is a bearish pattern. So what do we say happened after this pattern was created? We see price completely break down to the downside, right? So it retraces up to retest that last area of breakout structure. So that breakout structure, which we discussed last class, it broke through the last, low here. We got a retracement, we got a retest, and we got a drop. And if you do notice, we went quite bearish for a long time here. And that shows you how effective some of these patterns are. Because a lot of, not only us, right? A lot of traders are looking at the same pattern. That means we all are pretty much going to react the same way as the patterns that we see. So it's in a way a self-fulfilling prophecy that keeps playing out, right? So let me show you another one that I like is the bullish ascending triangle, or where is it? 1 second. The descending triangle, right? The bearish. So again, this is again a story that the market is telling you. So let me see if I can find a good example. I think I might have seen it with gold recently, or maybe SPX. Okay, so let me look through it, but the main thing to understand here is, say we have an area of resistance, right? Which we will look into in a minute, and an area, if you have a trend line there. Say price is in between the pattern, right? Between that zone there. So it's creating new higher lows, right? Creating new higher lows, but it isn't creating new higher highs. It's just creating a high. It's creating another new higher low, another high, right? So it's stuck inside the zone, creating new higher lows, but not creating new higher highs. So what does this tell us? This tells us that buyers in the market are pushing the price, creating new higher lows, but the sellers in the market are holding that area and not letting buyers push through it. And over again, they keep rejecting that area. So then what eventually happens is buyers push the price, breaking through the seller's resistance, and the price moves above, right? This is a bullish ascending triangle. If I had to actually invert this, let me invert this. And you see, this is a descending triangle. Again, the same story has been told, right? So the sellers in the market in this case are creating new lower highs over and over again, creating new lower highs. But the buyers are holding the support and just not letting the sellers penetrate from this low, right? So we just see a support kept on being, they keep on holding the support, the buyers just creating lows and low, right? Just low. And eventually what happens, the pressure gets so too much that the sellers penetrate through that area and now create a new lower low. So this is a bearish pattern that I like to keep an eye on. So let me move that there. All right, so let's look at a different pattern here. So just like a double top, we can have triple tops, pretty much the same thing. Bearish descending triangle. So we have a bearish flag and a bearish falling wedge. Vice versa, we have the same thing when it comes to the bullish side of things, right? A bullish falling wedge and a bullish flag. So a bullish flag the bullish flag is a parallel channel, right? So a parallel channel, I think I had a really good example here. One second, let me look into this. So I think it was here. Yep, there's a good example here. So if I had to draw out, so you see how in this particular example, price is stuck inside a certain channel here. And you see how price keeps bouncing off the channel over and over again, not breaking through, right? And eventually finds a small breakthrough there. This is a pattern that I like to look at, but I don't pay heavy attention to it because in my experience, I don't see it playing out perfectly every single time. It's something that you can take into account when just analyzing, but not when you're taking off trades confluences from. Yep. So this is a bullish flag. So basically in this case, the price should have broken bullish, right? So in this example, you see how it breaks bullish, but it doesn't truly break bullish. It actually falls back down. So these patterns I try to keep an eye on, but I don't heavily rely on them. So yep, someone asked if the same pattern on the head and shoulders can be inverted, right? Basically the reverse of it happening. So that can also happen, right? Let me see. I think I had a good example here on NASDAQ. So So if you look at the Nasdaq here on the 4-hour time frame, maybe, yep. So you see how price has a inverted head and shoulders there. So you see, one second. So you see how we have a left shoulder there, a head, and a right shoulder there, and you see how price perfectly breaks bullish because this is a bullish pattern, right? So we have, if you look at the story that this pattern is telling you, we broke through, we were in a bearish trend, we made new lower lows, but price did not hold. It came up directly, made a new higher low right on the right shoulder there, and eventually we got a third leg, right? So let me clear this to show you a bit clearly. So you have your left, your right, your head, and your right shoulder. And if you had to draw a line through there, you see how price creates that new higher low and breaks through the last high, yeah, creating a break of structure, which I've also noted on my chart, this current chart that I'm looking at. And then you see how price breaks through with that first leg up. We have yet to get that second leg happen, right? So this here is a bullish pattern that I like to keep an eye on. So those are the patterns and they play out over and over again. I would suggest the only way you can get used to looking at these patterns to train your eyes to look at them, right? You have to put in the chart time. So now let's look at pips and lots. If you have been researching about trading, I mean, you must have come across this terminology, right? Pips and lots. So what is a pip? Pip, like I mentioned in the first class, I believe, is a measuring tool, right? It's what measures the distance of price moving from point A to point B. And that's how we calculate pips. On the road, we use kilometers, right? So that's how we use pips. And pip, the full form of pip is percentage in point or price interest point. It's a Forex term, especially. Pip is what you'll notice in the Forex world. You won't notice in the crypto world and such. You don't notice a pip. And there's a big reason for that, right? Which I'll explain in a minute. So that's what I mentioned here is a unit of measurement used to express change in the value between two currencies. So we have a pair here, right? A British pound, US dollar. So always you have to remember that the first currency mentioned is usually the quote currency, and the second currency mentioned is usually the base currency. Always, yeah. So basically, if you look at your chart here, the price that's mentioned here is basically 1 British pound is equal to 1.27443 US dollar. Yeah. So it shows you the conversion of 1 pound because US dollar is the core currency. Yep. So you have to understand these decimal places. I mean, those decimal places when it comes to currency, they usually confuse a lot of people. So the price on your chart shows the exchange rate, right? Just like I mentioned. And most currency pairs, they can go up to 4 or 5 decimal places, just like I've shown you. But the Japanese yen pairs, JPY pairs, they usually go up to just 2 or 3 decimal places. So I'll show you that as well. So if you look at this chart here, the British pound US dollar chart, and if you look towards the right there, you see how the price has about 5 decimal places, right? But if you look over towards the Japanese yen pair, right? British pound, Japanese yen, for example, you see how we have just 3 decimal places in this case. Yeah. So that's the difference when it comes to Japanese yen pairs. They usually are 3 decimal places. And a lot of people actually find that easier to calculate because of the 3 decimal places. And there's a possibility why the Japanese yen pairs are so volatile as well. Yeah. So I have put a simple example here. So if price on Euro USD, for example, it moves up 1.04 to 1.043, that is a 30 pip move. Again, the same thing from 1.046 and drops to 1.036, that is a 100 pip move. So you don't have to manually actually calculate all the pips. We have enough tools on a trading view chart for it to calculate for us. Yep. So for example, let's take this pair itself. you can use this tool here, which is the price range tool, or you can use this tool here, the ruler tool, to if you want to quickly measure something really quick, right? So for example, I want to measure the price from 181,500, right? Almost the midway point towards the top here. And if you notice the numbers there, the 219 part, right? That is your pips. So price moved from point A to point B towards the top, and it moved 219 pips. Yeah. Again, the same thing. If you had to take, say, if price moved from area there all the way from towards there, price moved about 205.3 pips. So that's how you calculate pips with the trading view. It's quite easy. It's quite simple. Yeah. And the pips, the way it moves with the forex pairs, right? The currency pairs, this is how you measure them. But if you're someone who's interested in trading commodities, it works a bit different. So let's look at that as well. I have a few more examples with the British pound Japanese yen. So pip counts on commodities. Commodities could be such as gold, silver, oil, maybe you even trade wheat. Yeah, those are all commodities, and they're calculated differently. For example, we have gold and the dollar, right? And if you notice the price, it's usually calculated as dollars per ounce of gold. So if you look at the gold chart here, and you look at the price on the right, that price quote is basically that 1 ounce of gold is at the moment $1912. Yeah, because when it comes to commodities, it's not as forex, right? We are buying commodities or we're selling commodities for dollars, right? So that's how it's calculated with commodities. But this is where the confusion actually happens. It's when it comes to the pip difference, because when you look at the pip calculation, just how I showed it to you on forex, it's a bit different. So on TradingView, it shows you 1,000 micro pips. So the simplest thing to do here is to divide the pip count by 10, and I'll show you how to do that. It's very simple. So if you look at you have the ruler tool, and say you have picked up this area to here, right? And this area moved 7,581.9 micropips. All you do is divide this by 10, and you'll get around a 758 pip move towards the downside. Yeah. Let me show you or for example, if price move from point A here to point B there, right? 4,707 micropips. Divide that by 10, you get 470 pip move from point A there to point B there. Yeah. It's very simple. Just divide it by 10. And you need to understand the pip, how many pips everything is, how to measure it on your chart, because once we enter the trading section of the course, you'll need to understand how to calculate your lot sizes according to your stop loss, and your stop loss is obviously calculated depending on the amount of pips, right? So get a bit proficient and practice understanding how many pips your pair has and how it moves. So we looked at pips. So let's look at lots. So lot is a unit which denominates the number of currency units you'll be buying or selling. So when we place our orders on our platform, MetaTrader 4 or MetaTrader 5, which we'll be looking at later in the course, our orders will be based on those lot sizes. And why do we even use lot sizes? So for the basic idea of it, so if you look at this pair here, your Japanese yen, British pound Japanese yen, and if you notice the price movement here, about 238 pips. But if you look at the percentage move, right? The percentage move is just 1.31%, a very small percentage. And this pair right here is one of the most volatile forex pairs. And even though it's volatile, you see the percentage movement is 1.31%. And it isn't big, right? So if I had invested about $100 here, I would have made about $1.3 in this move here, right? A very tiny move. So to make a better use of this case, right, for us to capitalize on this move even bigger, we would use something called leverage, right? So we use lot sizes, and lot sizes is what we mention as leverage. So instead of 1.39%, we would buy, instead of investing just $100, we would invest maybe hundreds of thousands of dollars at this point and liquidate about hundreds of thousands of dollars, right? To make a dent in the profits that we make. So for example, so if you look at the lot sizes, right, this photo right here, you have a bunch of different lot sizes, and they're also have different terminologies. You have a nano lot, and this person who's trading nano lot usually has a small account, right? It could be between $100 or $1,000 depending on their risk management. A micro lot, right? A mini lot, and a standard lot. Standard lot is someone who's probably has a bigger account, probably someone who has between a $5,000 to $10,000 account, or someone who's playing it very close to the chest with very bad risk management on a $1,000 account. So standard is usually the highest one. And if you notice the volume, when you're placing your trades on MetaTrader, for example, if you want to buy a standard lot, you're going to mention the number one, and number one is a standard lot, right? And one standard lot signifies that you're buying 100,000 units of currency, right? So if you're trading the British pound, Japanese yen, you're buying up 100,000 British pound for one lot, right? And that one lot also signifies that every pip that moves on your chart, there's a $10 difference. So for example, same example there. Let me actually have a flat number, so to make life a bit easier. So we have 250 pips here. And say you decided to take a trade there and put your take profit there. Yeah. So you had a 250 pip move and you decided to put a standard lot, right? A standard lot is $10 a pip, 10 USD per pip. So you decided to put a standard lot there. And basically, if your price move from this point here to point there, 250 pips, you have now made a $2,500 profit, right? So 250 into 10. Let me type that out there. 250 into 10. You have now made a $2,500 profit, right? So that's how that's how we use leverage, right? Because in the market, the brokers, they provide us leverage so we can capitalize on these kind of moves. Because if we actually just invested spot, right, we just bought physical currencies, it wouldn't be very efficient and the profits wouldn't be as large as us having leverage in the market. Yeah. Same thing, we have your mini lot, and that would be 0.1 lot, right? This is the volume size that you'll be inputting into your MetaTrader, and that signifies each pip movement is $1. So in this example is a 250 pip move, right? So you will have about $250, right? So it's extremely simple math. You don't have to get confused with that. So I have put a few examples up here. So Euro USD price moving from 1.046 to 1.036. This is a 100 pip move. And if you use the standard size lot size here, you would make 10 into 100, $1,000. Again, with the British pound, Japanese yen, you have a 50 pip move and you used a mini lot, right? 10,000 units of currency, which is $1 per pip. So you basically made 50 into 1, $50 on the move. So that's pips and lots. Very simple. So this might be one of the most important sections of the class. It's support, resistance, supply demand zones, liquidity zones, and order block. Supply demand zones, I'll give you the basic gist of it. But supply demand zones, liquidity zones, is something we'll go in much deeper into the SMC section. Yeah. But before we go all into that, we'll look at the terminology and why it's used. So if you remember the first class, we mentioned that the market moves not due to the retail traders, it moves because of market makers. Yeah. So the market moves due to supply and demand. Supply demand zones are specific prices in the market where buyers or sellers find the price favorable to buy or sell. Very simple. In the Forex market, these buyers and sellers are called market makers. These market makers are big central banks, big institutions, not retail traders, right? They move the market because they bring a lot of capital and liquidity into the market. So a very simple basic example is if you have a limited edition Rolex watch, right, in the market, which is very desirable to a lot of people due to its limited pieces. This creates, due to the limited supply, this creates a high demand, right? The demand is very high. Therefore, we see higher prices due to demand. Very simple. So an example of Euro USD and Euro USD pair being bullish, the first example, when euros goes up in price, bullish, right? This means euro buyers came into the market as euro price was much cheaper, right? Due to the higher supply compared to the dollar. So people found that price so favorable that they wanted to buy up the euro. So buyers started buying up and longing the euro US dollar at that point in the market. Therefore, here what happens at that exact zone, sellers end up liquidating their positions. So the sellers don't see that area as favorable, right? They end up liquidating their sell positions due to the price being too low, and buyers step in, causing the price to rally bullish. Again, the vice versa. If euro USD is bearish, right, the euro is getting weaker, the dollar is getting stronger. When the dollar starts going up in price, which gains strength, right, this means the US dollar buyers came into the market as price was cheap due to a lot of supply compared to the euro. Euro had a premium price on it, so the people didn't want to buy it. So as this price is as this pair specifically, if you look at it, it's a euro with a base currency with a quote currency as the dollar. So in this particular example, the buyers here would basically be sellers, right? So if they're selling this pair, they're basically buying up the dollar and giving up the euros, right? So here buyers liquidate their buy positions due to the price being too high, and sellers step in, causing the price to rally bearish. It's an extremely simple concept. Yep. So yep, the cheaper currency is the stronger one. And I'll give you a few examples of that right on the chart. So look at this simple example here. You have a demand zone at the bottom and a supply zone. So a demand zone, in that particular example, we had Euro USD. So at the demand zone, the euro is cheaper, the dollar is expensive. Therefore, the buyers find euro a lot more favorable to be buying, and they end up placing their orders here, and we start seeing a bullish rally. Then at the supply zone there, we see a weak euro but a stronger dollar happen, right? Because the euro is too expensive at this point and the dollar is much cheaper. So they end up buying up the dollar, basically selling that pair. And we see a selling, a bearish trend happen. So I also have mentioned, where did I mention that? Hold on. I also mentioned that market makers, they usually focus on the higher time frames, just the daily, weekly, and monthly time frames, because they look at supply and demand only on the higher time frames because they are moving heavy amount of liquidity, right? So very simple concept here. Before we look at support and resistance, let me show you a quick example here. So let's look at a different pair here. Let's look at maybe the New Zealand dollar. So let me just give you a brief example on a demand zone and a supply zone. So all right, so let's see. Okay. So let's look at this zone here. Right, that's your supply zone there. Let me actually also mention it. Your supply. And let's say the zone down here is your demand zone. So what do we see happen? This pair here is a New Zealand dollar with the US dollar. Yep. So we see this bearish trend that happened, and see how when one price reaches this demand zone there, a lot of buyers start entering the market. We see a bullish engulfing happen, right? And I'm pretty sure maybe on the lower time frame, maybe on the 12-hour time frame, we also see a pattern of a inverted head and shoulders, right? You see inverted head and shoulders also play out. You see how I'm starting to combine all the concepts. So I see an inverted head and shoulders. I see a bullish engulfing occur. I see a break of structure occur. I see a first leg, a second leg occur, right? And a third leg eventually occurs, right? So what happens here is I see that a lot of buyers are entering the market there. Sellers are liquidating their positions. Therefore, I'll be looking to take long positions, right? And at the moment, price hasn't yet reached the supply zone. But if you look towards the left, you see how this area held as a supply zone. Basically, we see a lot of sellers enter the market, right? People who were buying up the dollar, who wanted to, and a lot of New Zealand buyers were getting rid of the New Zealand dollars, right? And we see a rally go bearish, right? So we see that happen, right? But you need to understand that the supply and demand zone won't hold all the time, because the market is always shifting and moving. A price that was favorable yesterday may not be favorable today, right? It may be favorable, but not all the time. You might see, I'll give you a good example here. Let me move this demand zone here. Actually, yeah, there's a good example there. And let me move the supply zone as well. Let's say this whole zone was a supply zone. Yeah. So if you do notice this example here, you see how we had a demand zone. Every time the price hit the zone, buyers found this area really favorable to buy. And every time the price hit around the zone here, we see price selling off, selling off, selling off, right? Every time. But eventually what happens? We see price actually break through the demand zone. Buyers kind of tried holding onto this area. And if you look at the bodies of these candles as well, you look at how small that buyer's pushback was. And eventually you see how massive that engulfing candle was with the bearish candle. We see price eventually break through, right? It gave us a break down. That means at this moment in time, at least, buyers did not find this area favorable anymore. This could be due to many supply demand is created by many factors. It could be most likely the fundamentals, the monetary policy in this particular case, the New Zealand dollar or the US dollar, the Federal Reserve. What kind of monetary policies they have announced, or they have announced, or are going to announce, right? So that's why the supply and demand zones are created, and that's how they keep shifting. So you have to, as well as traders, not predict, but react to what you see on the market every single day. Yeah, because all the time we have new supply zones and new demand zones being created. So let's look at support and resistance now. And supply demand zone is something we'll go very deep in the next in the SMC section of the class. We're going to look at how to fine tune those supply demand zones perfectly, and how I like to look at them for a big high risk to reward rates. So let's look at support and resistance. Support and resistance terminology is used here to recognize price barriers in the market. So if price is bullish, it moves off support. If price is bearish, it moves off resistance. So I've given you 3 examples here, and all 3 examples here, they qualify as a valid area of support and resistance. So the first one, you see how price touches a zone, a line there. So in this example, you have a support and a resistance and a perfect touch. So this is a valid area. On the second example, you have a gap. It doesn't perfectly touch that area. So Again, this is also valid. And the third example, you see a bit of an overlap. Price actually moves a bit down and then pushes up, vice versa. That also again happens. So this here is also a valid area of support and resistance. That's why I keep mentioning this is not a perfect market. It's an perfectly imperfect market, right? So you don't have to perfectly see price touch. It doesn't have to happen all the time. So to recognize an established resistance or a support area, right? You have in this example I've mentioned, to recognize an established resistance, this area should have been support in the past, or vice versa. It has to be an established support. This area should have been also a resistance in the past. This is very important to mark off our areas of supply demand on the chart. So I mentioned supply and demand. If you do understand, just like the market, right? Anywhere in the world, any supermarket or any mall, there's a price in the market that there are buyers and sellers who would favor it, and especially in a market so liquid, such as the forex market. You see this chart here. There is basically a buyer and a seller from every point in the market, from all the way up to all the way down. This shows you there are a lot of sellers and buyers in the market in every single point. But the question is, where are the highest amount of buyers in the market and where are the lowest amount of buyers in the market? And for me to, for example, recognize support and resistance, for example, so I mix up the supply, demand, and support resistance together, right? So in this example, we look at support resistance. And what I like to look at, there are a bunch of support and resistance in every single time frame, all the way even towards the seconds time frame, right? So I like to mark off my support and resistance usually in the weekly time frame or the daily time frame, right? For the broader picture, and then the lower time frame for trades that I'm looking to take, like currently, right? Like in the upcoming week, which I'll show you an example of for. So I like, when it comes to drawing my support and resistance, I like to look at the wicks of the candle, not the bodies of the candle, the wicks. And what do wicks represent? I have always mentioned that the wicks represent high buying and selling pressure in the market, right? So in this example, I'll mark off, let's see, right? I've marked off this area here and I'll show you why. You see an area, that wick right there, push through. You see a bunch of wicks. You see an overlap as well, that's fine, right? You see another wick, that aggressive wick that shows there is a lot of demand or supply there. Again, you see those wicks, right? So for this to be a valid area of support or resistance, it has to have been used as a support or a resistance in the past. And that's what I'm showing it to showing here. Yeah. Let me give you another one example. Let's see. Okay, let's say this one, right? You have an area of support, an area of resistance, support, support, right? Support there, a brief resistance, right? Again, support. So you see how this area has been used as a support and resistance, showing that usually at these areas, we see buyers or sellers hold this area, right, in the past. Therefore, this areas could be higher probability for you to be taking trades from. Again, let's actually continue the trend. Let's look at the zone, if we have any other zones in between. And we have one right there. You see how we have resistance at those massive wicks, right? Support, right? Support, support, right? So this area is a valid area of support and resistance. So some traders would look at even finding support and resistance inside these areas as well. I mean, it is valid, you could, but me personally, I like to look at areas of high aggressive amount of buying and selling pressure, and those are only signified by the big wicks, right? So for example, let's see. So some traders would, for example, yeah, mark off this area there. This area would be, let's make it a different color. You see how this area is valid. It's valid area of support and resistance. We do see that happen, right? But you see how price, the wick is not perfectly, at least not perfectly overlapping either. You see how the bodies keep closing above. The wicks are not perfectly rejecting. This wick at least is, but these are not. You see? So that doesn't signify to me a perfect area of support and resistance. It is a valid area, but not a perfect one. Because at the end, we are dealing with probabilities. We need to pick up areas which have the highest chance of price going in our favor. Yeah. So that's what I mentioned here. An area of support usually gets used as an area of resistance. Again, an area of resistance will also be used as support, which I just showed it to you, right? Right there. This area which was being used as, let's see. So this area here, which was used as support there, was used as a resistance. So that's how you identify an area of support or resistance. So before we look at trend lines, what I like to do or used to like to do, I don't mark off every single thing now because my eyes are extremely trained with the market. I don't mark off every single zone. But if you're a new trader, which you all are, best thing to do is, I'll show you what to do. Let's actually pick up a new pair instead of deleting everything here. Let's look at AD USD. So we look at the weekly time frame. So I would suggest to mark off, if you look at the price here, price is trading currently around there. Yeah. So mark off your weekly areas of support and resistance between the price action which is going on here. So I will look at the top and the bottom and mark off those areas first. Yeah. So in this example, let's see. So I'll mark off maybe this area there, possibly. Yep. There. Or actually, a better one would be right there. Yep. So why here? We see resistance, support, right? Support. So this area is a very valid area of support and resistance. Second area would be somewhere around here, which would be here. Yep. Why? Look at the wicks, that area of support, sorry, resistance and area of support and resistance there. So this area is a valid area. So now that I have marked off, I'll see if there are more areas in between here which are valid. There seems to be one, but it's not perfect, right? So every time you don't have clear picture, always scroll a bit towards the left. So like over here, man, this price action is extremely old. This is a 2009 price action. That shows you the state of the market at the moment. But possibly there could be a support and resistance here. Yeah. You see? But not the best. I don't like this as much because we don't have massive amount of rejections. We do have some here, but if you look at the current price action here, you see how price slices through in between these bodies. I don't personally like that. So I would remove it. Yep. So let's skip this zones for now. Let's look at the daily time frame now. So I mark off my weekly time frame. Then we look at the daily time frame. We do the same thing in between these two zones. So you can color coordinate them. So for example, I have put white line for my weekly time frame, and let's use a different color for the daily time frame. So let's use a color, let's use purple then. So we have an area of support, right? Support, we have resistance around this area there. So it's a valid area of support and resistance. And let's see if we have few more areas here side. It's a lot of choppiness, right? If you look at this area, there's a lot of choppiness happening here. So this when you have a lot of choppiness like this can confuse you a bit. So you need you can take your time and mark them off. Just because I'm a bit more experienced, I'm going through this a bit quickly, but you don't have to. Yeah, take your time and perfectly mark them out. So there is a possible, yep. So we have a support, resistance, right? You see that perfectly keeps on getting held, right? This area. So this is a valid area of support and resistance on the daily. We have possibly another one maybe here. So again, support, resistance, support, right? So a very valid area of support and resistance. So this is how I would mark off my chart when price is trading like this. So I want to try mark off the support and resistance between that price, a zone, right? Just like this. So say I had marked off my chart like this. I'll go down to a lower time frame and then maybe start looking at my supply demand zones, which we will go much deeper in the SMC section. This is why I'm not going through them now. I just want you now, for now, just understand support and resistance. Once we start going to SMC section, we'll be clearing up our charts. Maybe in situations we won't even be drawing these supports and resistance as nicely, right? So for now, I would suggest to draw them out and see how price reacts to these areas. Now that you understand what a trend is, what are the patterns in the market, and even if, again, if you look at this, just a pattern, again, head and shoulders, right? Price breaks through. What is now supposed to happen? Maybe price will now retest this area, right? So very simple, just mark them off on your weekly and your daily for now, yeah? All right, so let's look at trend lines now. I'm not the biggest advocate for trend lines, but trend lines do have a place in the market, and they are one of the oldest trading tools that traders have used over many years, right? So trend lines help us determine the market direction. And it is also used as a support and resistance by some traders. So for me, I like to look at trend lines. A valid trend line needs to have 2 or 3 taps on it. So if you look at this example here, you see how price taps the trend line once, twice, then a third time. That shows you that this is a valid trend line. So let me show you a few examples here. Okay, there's a good one, possibly here only. Let me actually delete this. So let's draw a trend line there. When it comes to the trend line, from the beginning point, I like to put in those wicks, right? I don't want to start off like with the bodies. I like to keep that wicks inside in, right? So that's tap number 1. Let me use, okay. Yeah, that's tap number 1. Tap number 2 there. Then we had tap number 3. This kind of overflowed over the trend line, which is fine. But this qualifies as a trend line being held because the body of the candle did not close below the trend line. So this is a bullish trend line. So it held, again, another tap. And eventually price breaks through the trend line there, right? And this trend line is now invalid. So a lot of traders who like trading the trend line, they would trade on by, like, for example, when price taps the trend line, they would take a long position. When price taps the trend line, they take a long position, right? When it taps, they would take a long. So trend line traders would do that. I like to personally look at trend lines by just for analyzing purposes on the higher time frames, but on the lower time frames, I like to use trend lines sometimes when it comes to taking entries, which I will get into a minute. Yeah. So just like the support and resistance, a broken resistance trend line here, a bearish trend line, can be used as support, right? Let's see if this example has a. So let me stress this out a bit, and then we look at a bit in the lower time frame. So in this example, we got that break happened there, right? It broke through the trend line towards the downside, but we did not get the retest here. So usually sometimes price would come up to the trend line, retest the trend line as a resistance and drop. So a lot of trendline traders like to use that, to use the trendline as a support and resistance as well. So when it comes to trend lines, me specifically, just using them, I like to use them on higher time frames to analyze, but the lower time frames, I like to use them as entry. So let me show you what I mean by this. Let's go to a lower time frame. Let's say I'm looking to take entries on a small time frame, right? On a 15-minute time frame. I like to use trend lines in a counter direction. So for example, what I mean by that is, let's say over here, okay? Let's say I'm looking to take an entry at this area here somewhere, yeah? So I would draw a trend line in the counter way. I want to take an entry to sell short position, right? I want to take a short position from this area here, somewhere here, yeah? And my stop loss would be somewhere there. So in this example, I see a counter trend line happen, right? A bullish trend line. I see tap one, tap two, tap one, tap two, right? A tap three happens, right? And we get a break, right? And say I was looking to take an entry around this area there. This break of structure, break of the trend line, and a break of structure also happens, which broke the last higher low. Not only that happens, we also see a bearish candle, bearish engulfing candle happen. So I have so many confluences here, right? And including the trend line, that gives me a confirmation to now take entries around this area here, yeah? And once I see that bearish engulfing, there is an entry, stop loss there, and my take profit will be somewhere down, right? We'll look at take profit later in the later classes, but that would be my entry, yeah? So I look at trend lines, for example, in a bearish trend, and I'm looking to take sells, I will look at a bullish trend line on the lower time frame. And on a bullish trend, when I want to take long positions, I will look at a bearish trend line. So I want to see if the trend line breaks on the lower time frame for me to take long positions from, yeah? So it's basically a counter trend line, yeah? So let's look at the next one now. All right, so we're going to fine tune this even further, right? We're going to fine tune our area of support and resistance even further, right? Even our supply demand. So around psychological levels. So psychological levels refer to key price points in the financial market that traders believe that have a psychological impact on market participants, which are the traders, right? And therefore they impact the market behavior. So they are often, these psychological levels are round numbers in the market that traders watch closely and use as decision points for entering or exiting trades. These levels can act as support and resistance, and traders may place orders at these levels, leading to increased buying or selling pressure, influencing price movement. Right. So in this example here that I've just this picture right here on Euro USD, you see how I've put in a flat number, right? A flat round number, 1.08, 1.07. And if you look at the number, you see how we have reactions every single time of that area right there again, right? And why does this happen? The market participants, especially the big ones, right? The ones who move the market, the big institutions and central banks, they would be placing orders at these areas at flat round numbers. They wouldn't look at 1.07135, you know, they wouldn't look at all those decimal places. They would take a nice flat number in the market. That's where they are looking to place their majority of their orders. And that's it, yeah? And that causes the market to react and move off those psychological levels. So if you look at let's look at a nice example here. So let's look at AUD USD here. And let's look at the daily time frame. And let's look at the flat numbers. Let's pick up some few flat numbers here. Let's say 0.65, yeah? 0.65. Then let's pick 0.66 maybe. Let's also pick up just for one more 0.67, right? And now let's see what happens at these areas, these round psychological levels. So you see how we have a reaction of that area. You see how the market ends up moving up off there, over there again. You see how the market has a massive reaction here. Let's look at on the second example on the top at 0.66. You see how price has reactions there. Also a valid area of support and resistance. Yeah. And also the another area on the top, we see massive reactions, right? Because a lot of market participants, the central banks or these big institutions, are placing their orders there. Yeah. And over again, you'll see this pattern repeat with these flat numbers in every single pair. It could be not only Forex, it could be commodities, it could be indices, stocks. Yeah. These flat numbers have a massive significance in the market. Let me show you just one more example, maybe. So let's look at maybe let's look at CAD, Canadian dollar, right? Or JPY. So we have let's pick up a flat number, 100, right? This example. Then we'll pick up another flat number. Let's pick up 101. And just let's look at these both levels. So let me move on to a lower time frame. So you see this area here, yeah? You see how this area has massive reactions every single time, pretty much, this round psychological levels. Yeah. This shows you there are a lot of massive market participants placing their orders at these areas of psychological levels, right? These flat numbers right there. So that when you're drawing out your support and resistance, I would suggest to not only like just randomly draw it out at these just decimal points, which can be done, is fine. But if you want to really fine tune them, try to get them at certain round levels. Yeah. Before I get into that, let's look at quarter points before we end the class. Yeah. So round psychological level, very important. Now we're going to look at this in more detail. Yeah. So we look at something called as quarter points theory. So quarter points theory suggests in a 1,000 pip range, right, between two major whole numbers, right? In this example, we see 170 and 180. Those are the major two whole numbers. Price moves occur in a 250 pip increment. So price moves in 250 pips at a time. Therefore, we have 4 equal parts of 250 pips. These areas can be used as supply demand. Also, a 100 pip range can be also used vice versa instead of a 1,000 pip range. And that can also be divided into 4 equal parts, 25 pips, which could also be your quarter points. These quarter points are used as supply demand areas or support and resistance. Quarter points can be used as on any instrument. In fact, any instrument, on Forex, on crypto, on commodities, on indices, on any instrument. And they are very useful when you are actually marking off your supply demand zones or your support and resistance. So an example here of a 1,000 pip range on, I think this is a British pound Japanese yen. So you see how we have a massive range, right? We mark off a flat number 170 and 180. And this is a 1,000 pip range. Then we mark off our midpoint, which is a 500 pip range, right? That is your half point. And then you mark off a 250 pip range from your major point, right? And this is your quarter point. Again, you have a quarter point between that half point and that major point there. That is your quarter point. So if you notice, there are 4 different halves, 250, 250, 250, 250. And there are a lot of reactions in the market at these 250 pips increments, which I'll show you. Actually, let's see USD JPY maybe. And let's go on a daily time frame. So let's pick up a flat number, 140. And let's pick the next whole number, it's at 130. Yeah. So if you notice this range that I've drawn out now, this range here is 1,000 pips. So this is 1,000 pip range there. Now, once you've drawn out the 1,000 pip range, you need to mark off the halfway point, which is 135 in this example here. So if I draw out the measuring tool there, so you have your halfway point there, yeah? And in fact, I actually mentioned that this is your halfway point. So half, right? Halfway point, and your major there, major points, major whole numbers, major. All right, and then you pick up another half point between that half point and the major point, which is now your new quarter point, and this would be at 132,500 in this example. So you clone that and right there. So that's your quarter point there, yeah. Same thing. Let me clone that. Put your quarter point there, 137, 500, I think. Yep, there. So this is your quarter point. So you notice how price moves in 250 pip increments at a time. And if I delete this, and if you look at the reactions at these areas, it's in a way, it's kind of a witchcraft, right? Because you see how price exactly reacts to these areas all the time. So you see how we have these areas, right? It keeps reacting of these areas. These areas are used as support and resistance as well, right? Again, there. You see those impulses happen there, or those areas. There's always some reaction happening, right? All the time. So this shows you that these areas, these flat numbers, and also your psychological levels, which are your flat numbers, you pick them up, your major points, you have this range, 1,000 pip range here. And if you split them in 250 pip increments, you have a lot of reactions happen in the market on those 250 pip increments, yeah? But there is a way to fine tune this even further, right? So, yep. So someone mentions this is not a theory, it's a fact. But yep, again, at the end, everything in the market is a theory in a way, right? Because no one truly knows exactly if it's going to happen every single time, if it's going to be a buyer or a seller pushing off those levels. That's why I think we call it a theory. So so this is a 1,000 pip range would be someone who's actually looking on a broader time frame, right? Someone who's analyzing the market on a broader time frame, or perhaps a swing trader. A swing trader would be someone who would look at a 1,000 pip range and look at the reactions of the market. But if you're someone who wants to day trade, right? We're going to look not at the 1,000 pip range. We'll look at a 100 pip range. And a 100 pip range would be, let's start with this major point there at 130, and we'll take a 100 pip range from there, which would be at 131. 131 is a 100 pip range. Actually, let me just move this point here once. Here. So those are your two major areas, right? A 100 pip range, and then you have your mid area at 130,500. There, that is your 50 pips, right? Your halfway point here is your 50 pips, and then here you have your quarter point there, and your next quarter point at here, right? So you would use this 100 pip range on a lower time frame, right? On a, let's say, let's look at a 4-hour time frame, right? Let's zoom in a bit here and look at the reactions that happen. Actually, yep, I think this is fine this time frame. So you see how we have reactions happen here all the time. You know, even on a 100 pip range, there, right? See? So this shows you that this theory, right, is also applicable on a smaller time frame with a 100 pip move, which would be more beneficial for someone who's day trading. So now if you now what I like to do is not to mark off every single thing on the chart, like not every single quarter point, not every single major point. So you can do something is you can combine the way I draw my support and resistance on the weekly time frame, for example. So when you're marking off them using the areas of aggressive buying and selling pressure, because not every quarter point or a half a point or a major point has aggressive buying and selling pressure, right? I like to look at an areas of very high aggression. The reason why is when price hits those areas, there is more likely to go in your favor. Yeah. So in this example, on a weekly time frame, so this is not the best chart here. Wait, let's look at a different one. Let's look at CAD USD maybe. Or yep, let's look at actually it's USD CAD. Sorry. Yep. So look at the weekly time frame here, and we'll, for example, easy way to mark this off. You have your area of reactions, right? You first notice that happen. Then fine tune the coordinates. Pick up that area. See if you can align that to a quarter point. In this example, it would be 132, 250, which is a quarter point, right? So you mark that off. So that's a nice flat number. And you know, in the back of your head, a lot of market participants love to enter these areas. So you have two confluences that this area is a high probability. You have these wicks, right? A lot of reactions happen. And also this area is a quarter point and a round psychological level. So you have three confluences. Therefore, this makes this area extremely highly probable. Let's look at another one. So let's look at this area here. Again, so this is another quarter point, 132, 250, 134, 250, sorry. And if you do see, you see how this area held as support and resistance, right? We always had heavy reactions of this area here. You see those wicks? So this area is a nice area. I would mark it off, right? But according to our quarter point theory, there's probably another quarter point in between here, right? But that's the reason why I don't mark off all of them off. I like to look at these wicks. I like to also keep in mind the round psychological levels and the quarter points, and then just mark them off. I don't want to mark off everything and clutter my chart. Yeah. So that's how you fine tune these areas. And that would be the best case scenario when you're marking off your support and resistance on the high time frames, or even your low time frames. Yeah. So for now, I think we are done. Let's look at if you have anything left. So yeah, I have given you another example with a 100 pip range on British pound Japanese yen, right? Just an example. So for now, we'll end the class here. Let me stop.